Assalamu alaikum wa rahmatullahi wa barakatuh. Welcome back to the Campus Dialogues, a Muslim Views production in affiliation with MuslimFin. MuslimFin, your roadmap to Islamic banking and finance. And for another exciting episode this evening, to introduce my guest, we haven't seen you guys in a while, and I haven't seen him in a bit. Siraj Music, Siraj.
Assalamu alaikum. Ali, how you doing?
Alhamdulillah, good to be back.
Always good to be back in studio. And like I always say, another week, another podcast. But it's been a while since we've been back.
Yeah.
And before we kick off perhaps proceedings, I'd probably just like to take this opportunity and welcome you back from your holy pilgrimage. Hajj.
Alhamdulillah.
It's good to have you back. And we make dua that Allah grants you a Hajj Maqbool and Hajj Mabrur. And accept all the du'as that you've made for us and and
for the channel.
For the channel as well.
May it grow
from
strength to strength, inshallah.
Grant those who haven't been on Hajj, the opportunity to go, and those who've been there before, obviously longing to go back. So, inshallah, perhaps in the near future, we'll probably have a special episode where you can perhaps share, some of your insights of your journey.
I have lots to talk about, lots to share.
I'm sure it will inspire, the community. So, moving forward, our guest tonight is no stranger to our podcast.
Absolutely.
Someone we had on the podcast.
Call him a regular.
Yeah, he's a regular. He's part of the team. He's part of the furniture. So we're always happy to have him in studio. Saleigh Salaam, welcome back to the podcast.
Assalamu alaikum wa rahmatullahi ta'ala barakatuh. It's always a pleasure to spend time with you in your company. Alhamdulillah.
Saleigh, I think the last time we spoke to you gave us a market update at that particular point in time. And since then and now, a lot has happened.
Yes.
Globally, what's impacted the global markets and as well as the South African markets as well. And inshallah tonight you're going to give us another update in terms of where we are and perhaps just pick your brain on some of the things that is impacting the investor out there.
Inshallah, I'll try my best.
Do we have the slides up? Cool, there we go, market update.
All right, inshallah. So, if we go on to the first slide, I think what's quite interesting to reflect upon is if we take score, in a sense, as to how the different asset classes have behaved for the first half of the year. It's quite interesting that if you look at the slide that's up on the screen, that the best performing asset classes are actually commodities. You've got platinum, which is up 43%, soybean oil, which is up 27%, gold up 23%, palladium up 20%. So you've got a number of commodities basically making the top five asset classes, and this is not just within the context of South Africa. This is taking a global view, right? And bringing up the rear right at the bottom, you actually find orange juice down 52%. So now is a good time to go to the mall and buy some orange juice, right? So commodities have really been where let's call it the action is at, and where you've had significant and in fact dramatic outperformance by certain key commodities. It's quite important because platinum palladium, South Africa actually produces around 70% of platinum within the world. So it's really, really important from a South African perspective. If you look at that chart as well, you can see, for example, obviously everyone likes to focus on tech and the tech sector and how that's done. The Nasdaq is only up 4.5%. Year to date. So you've had, let's call it 10 times outperformance of platinum versus the Nasdaq over just over 6 months.
Yeah,
Subhanallah. It's quite dramatic. If we go into the second slide, bringing it closer to home. If we look at certain sort of key asset classes, as we call it, and I'm just going to focus on sort of a more meaningful time period, which is, let's call it, for the 1 year to the end of June. You can see the South African stock market, what we would call SA equities, are up 25%. Bonds, which are basically fixed income investments, are up around 18%. Global equities, that means investing in the MSCI world, is only up around 13%. Global bonds is up 5.6%. And then the dollar has actually weakened over that time period, down around by about 4%. Alhamdulillah, I heard you called Muhammad Ali, which is great, but we should actually now refer him to as Haji Muhammad Ali.
Oh, 100%.
And he would have noticed that when he did his foreign exchange transactions, actually that his rand went a little bit further, right?
Yeah.
Especially against the Saudi riyal, which is ultimately pegged to the dollar. Why? Because the dollar has weakened, and conversely, the rand has strengthened. So that's important. If we now look at it onto the following slide, so that's slide number that's I think the one you're at, SA equity returns, and we dive just a little bit deeper, sort of, let's call it beneath the hood, because I just showed you how the JSE as a whole did, but we focus on sort of the subsectors. Where you've had dramatic performance has been from over the 1 year, has really been in the resources, what we call commodities, up around 30% for the year. Industrials up slightly below that, around 29%. We spoke about earlier that the broader JSE index did around 25%. The property index 24%, and then financials, which of course we as Sharia-compliant investors typically don't invest in, that did around 18.5%. So those were the drivers of the stock market return, and within that you can also see what we call significant dispersion or variation between the winners and the losers. As I showed you, the difference between let's say the Nasdaq and the platinum was a factor of 10 times, right? Or platinum did 43%, but orange juice is down 53%. So that means there's like a 90% outperformance of platinum versus the orange juice just over 6 months. And even within the JSE as well, significant variation between the winners and let's call it the losers or the laggards. If we now go on to let's call it the next slide, maybe just something I thought it's quite important for your listeners to just be mindful of. If you can go on to the following slide, please. And we look at, typically when we talk about sort of returns, right, and you break it down into its component parts, what we call, let's call it first principles, its component parts, what makes up a typically total return, especially when you're talking about, let's say, companies, right? It's typically going to consist of how much the companies grew their profits. It's also going to include the dividend yield, right? How much income the companies are actually paying out to their investors. And it's also going to include what we call a ratings change, which simply means has the value of the company gone up, right? Let's say from 10 to 12 or 10 to 20, has it actually gone up? And then the final part, which we tend to ignore, but it's exceptionally important, especially because we're living in an increasingly global world where investors, Muslim investors as well, not only have opportunities to invest locally, but they can also invest globally. Yeah. They can decide, for example, that they want to invest in Al Rajhi Bank, which is one of the largest banks in Saudi Arabia, and it's a Sharia-compliant bank, for example. If you were to do that, not only is your return going to consist of how much Al Rajhi Bank grew its profits, the dividends that they've given you, but also the how the valuation has changed. It's also going to include a currency portion, right? Did the currency strengthen or weaken? And that's a really, really important factor to bear in mind, because we as South African investors in particular, we've almost become used to the idea that the rand over periods of time is going to always weaken. And as I showed you in one of the earlier slides, actually the dollar, and implicitly and by extension the rand, has strengthened. The dollar weakened and then the rand strengthened. So now you as an investor, South African investor, wanting to invest in Al Rajhi Bank, or you want to invest in Novo Nordisk, for example, now you can't just think about, oh, well, this is a really great company and this is how it's going to grow its profits and this is the dividend yield I'm going to get. You also need to consider, am I going to make money or lose money from how the currency is going to behave? Because that can actually have a significant positive or, conversely, a significant negative effect. Let me show you onto the last slide, or the second last, the next slide, inshallah. So let me show you some asset class returns, but from a South African investor's perspective.
Okay.
Right? South African. I'm not showing you dollar returns. I'm showing you rand returns. Okay. So this is just for the first half of the year in sort of orange. Sorry, in blue, and in orange you've got the 1 year return in orange.
Okay.
Now let's look at the JSE Resources Index. Okay, the JSE Resources Index for 1 year to date, subhanallah, is up 47%. That's the Resi 20, the 20 biggest resource stocks on the JSE is up 47%. For 1 year, it is up 30%. Now let's look at the S&P 500, right? The biggest companies in the US, and by extension, some of them are actually some of the largest companies in the world. For the year, that it's only up 9.5%. That's in rands.
Okay.
If I put my money with FNB Islamic, I can get that kind of return, probably, maybe 8%. So it did just slightly better than putting your money in the bank. And in fact, year to date, in rands, you actually lost money. You actually lost money. Why? Because of the currency. Because of the currency. Let's look at emerging markets, of which, of course, South Africa is a part. Yeah. But it's a small part, right? But emerging markets as a whole, year to date, meaning for the first 6 months of the year, it's up 6.6% in rands and 8.7% or so over 1 year. So you can see there's a massive difference between the returns that typically some people are quoting you. They're quoting it to you in dollar terms. But you are a rand-based investor, right? You are a rand-based investor. Ultimately, what matters to you, if all your assets and typically your liabilities are in rands, is what is your rand return? You're not saying you don't want to invest offshore. Of course, there's some really great companies that are to be found offshore. Some good opportunities to create long-term returns for you and other investors. But don't ignore the currency effects, because it can have a material impact. Because if the currencies are overvalued, you could potentially lose money, even though the companies that you invest in may be really, really good. Nobody disputes that the S&P 500 companies are some of the biggest, most profitable companies in the world. But if the dollar's overvalued, you're going to lose money. So that's sort of just a key point that I wanted to bring home to your investors, and they should not assume that the rand is always going to weaken against the dollar.
Absolutely. I see that you still have a couple.
No, I think I can. I can. That's kind of like the key central point that I wanted to just bring home.
That's very interesting because I have quite a few questions for you now, just around this. So, the fact that resources are doing so well, could this be because of a few reasons? So, the tariffs that was recently put on China, does that have anything to do with it? And also, because South Africa, like you said, when we looked at the one chart, platinum and palladium was doing exceptionally well.
Yes.
Okay. Then orange juice, on the other hand, not doing that well. Okay, all the way at the bottom. But South Africa are, I think you said 70% for platinum and palladium.
Yes.
As an exporter, right?
Yeah.
But then for citrus as well. I mean, so we are one of the largest exporters of citrus too. And
Yeah.
So is that different because it's orange juice, or in terms of orange juice versus oranges, right?
Yeah, orange juice. Yeah.
Okay.
So when we talk about commodities as a whole, particularly in the context of, let's say, the Johannesburg Stock Exchange, of course, you're not going to get companies that by and large are 100%, let's say, exposed to orange juice on the JSE.
Yeah.
Our companies on the JSE are typically involved in what we would call basic materials, as well as precious metals. And basic materials can be things like iron ore, coal, copper, and so on. And you've got precious metals, which is then split between gold and platinum. And one of the main reasons to your question with things like tariffs and so on, when you spoke about China as well, why the market, the JSE as a whole, and resources and the Resi 20 in particular have done exceptionally well, because those sectors are totally dominated by gold and platinum companies.
Okay.
So anyone who was invested in the, let's call it the Resi 20, for example, meaning the 20 largest resource companies on the JSE, if you invested in that sector, you are almost getting a pure exposure towards the biggest gold and platinum companies in South Africa.
Okay.
And given the significant outperformance, dare I say, hypersonic performance of platinum, as well as gold, over the last year, for example, and even year to date, in particular, it's no surprise that the Resi 20 or resources index has done so well. That then also within the makeup of the South African Stock Exchange, because it's got a significant resource bias, means that it's sort of lifted the entire performance of the JSE. So if you think of, for example, let's look to a completely different market. You look at, let's say, the S&P 500, for the sake of argument. That market is a lot more dominated, let's say, by the performance of tech.
Yeah.
We don't have that sort of structure. Our market is a lot more dominated by, let's call it, resources and commodities, which is why we've done so well. And then to your question around tariffs in China and so on, yes, of course. I don't know if you recall, when at our last conversation, I told you, gold was like really, really attractive.
Yeah.
And one of those reasons, and it remains that reason.
Just to interject, at that point, I think it was below 3,000.
Yeah. And
you were saying it's definitely going to hit 3,000, and now, I mean, it's comfortably sitting at 3,200.
Yeah, alhamdulillah, alhamdulillah.
Probably going to hit 4,000 now.
Yeah. We'll take that as a dua from Allah. Alhamdulillah. Yeah, so let's look at tariffs. What tariffs has basically done was it's created significant uncertainty in terms of what is called the historical sort of rules-based order. And that rules-based order was being threatened of being, in a sense, torn up or upended. That's essentially what tariffs represented. And in that sort of context, what's actually happened is that investors, typically in times of significant uncertainty, what they do is they buy gold. They buy gold, and that has been one of the drivers. In fact, not the only driver, but since we last met, that has been one of the drivers of a rise in the gold price. At the same time, you've also had Chinese demand coming through for platinum in terms of jewelry. You've had a slowdown in terms of EVs and electrification, and a more move towards kind of hybrid vehicles, which typically also use platinum to become more emission efficient, and that has all contributed towards significant price action, as you've seen in platinum, coupled with, of course, significant underinvestment and pullback in supply of platinum globally. So any change in demand is going to have an outsized sort of effect upon the price of platinum, because you've constrained the supply, and then where can you get it? You can only get it principally from South Africa, because we supply 70% of the world's platinum. Some of it also comes from Brazil, but really, 70% comes from here. So that's had a significant impact upon the performance of our market, and hopefully that sort of answers your question.
Yeah, absolutely.
So it seems like these commodities like gold and platinum, it's becoming more of a safe haven asset, right? And obviously with the price increase, it's obviously highly beneficial for producing countries like South Africa and Mali and Ghana. But does this signify global economic instability, really, which could have a negative impact in terms of the spillover effects on the financial markets and investment inflows into Africa?
Very good question. So, on the one hand, let's say investors, global investors, want to buy platinum. There's only not quite one place, but one major place, one major supplier to kind of buy it from. That is from South Africa. So what they're going to do, they are going to buy platinum, the commodity, and that's actually going to have, let's say they decide to buy some of our platinum companies on the JSE. For example, stocks like Northam, or previously called Amplats. What do they need to do? They're going to sell their dollars or the euros or the yen, and they're going to buy what? They're going to buy the rand, right? Because they can only buy these stocks in rands. That then obviously increases the demand for the rand, which then, for example, strengthens the rand. And that's going to register as a, let's call it an inflow, to your question, into our market, right? Into our accounts. Excuse me. On the other hand, the same can also be said for gold. South Africa remains a major, not quite as big as it was before, but still one of a significant producer of gold, and some of the most what we would call levered, meaning geared companies towards the gold price. So, and a global investor that is saying, look, given all this tariff action, given all this geopolitical uncertainty, I have a really structurally bullish view on gold. One of the best ways for that investor to express that investment view, in that investment thesis, is to buy some of our really geared gold companies. Because if that investor's right, then, for example, shares like Harmony, for example, are going to go through the roof. They don't want to buy necessarily a gold company that's not necessarily geared towards the gold price. That's maybe listed in Canada. Let's say like Barrick or Newmont, for example. They want to buy the one that is the most geared towards a rising gold price, and that's going to be here, let's say, in South Africa. Why? Because our gold mines are some of the deepest in the world, and it's some of the most toughest sort of engineering exercises to get that gold out of the ground. I think hopefully that addressed your question.
Saleigh, are you saying that because previously what I heard was that, and look, I've been on Hajj, so I've probably not been as clued up as I normally am, but and my understanding is that the rand is not necessarily strengthened, but it's that the dollar is weakened so much. Is that the case, or are you saying because of the amount of flows that we're seeing from international investors into these various companies that are exposed to or mining, the miners that are taking out platinum and gold out of the ground, that it's actually strengthening the value of the rand as well as the dollar weakening?
It's both.
Okay.
It's both. So on the one hand, the dollar has weakened, and in fact, its performance over the first half of the year, it lost about 11%, in fact 10.7%. The so-called dollar index is down 10.7% for the first half of the year. And that is its weakest first half performance since 1973. Sure. Right? That's the post-Bretton Woods agreement when Nixon took the US off the gold standard. I was born in 1974, right? So it's like a really long time. really.
All 70s babies, at least me.
Right? So that's a really, really long time. We're talking about like 52 years or something, right? It's the weakest it's been in 52 years. But in addition to that, there's an interesting relationship between it was my last slide.
Okay.
It was my last slide where I actually showed the platinum price.
Should we pull it up for you?
Yes. Where I actually showed the platinum price. And the chart on the right. So what I showed you, what I basically showed you there is the platinum price in orange. And you can see literally, I mean, I wasn't joking when I said it's went hypersonic. When you look at that last line at the end, it's just gone.
Wow,
it's just gone straight up. I mean, there was no pauses, nothing. It just literally went straight up. Okay, and then in sort of blue stroke purple is the rand, but the inverse of the rand. Okay, so what happens is when that blue line is basically you can see it's kind of going down. It essentially means that the rand is strengthening. Okay. Now what's actually happened? Look at the relationship between the blue line or the sort of purplish line and the orange line. They basically track each other.
Yeah.
Now what that is basically telling is look at how the platinum price has gone up, but now that relationship seems to have broken down. The blue line is not following the platinum price. So that's basically telling you, it's indicating that there's a potential for the rand to actually strengthen further.
Okay.
Right, because of that relationship between the platinum price and the gold price. And if you look at the chart on the right, what that showed you is exactly as I referenced earlier in my discussion, where I basically said, well, platinum, it's really concentrated here in South Africa. 70% comes from South Africa. The balance comes from Zimbabwe. Russia is essentially off the market, right? Because of all the sanctions.
Sanctions, yeah.
Right? So it's really South Africa and Zimbabwe, and in fact also South African mines also, which are listed here, of course. Some of the platinum mines also own the mines in Zimbabwe. So if you want to get that kind of exposure, you've got to come here.
Okay. Very, very interesting.
Saleigh, shukran for that. So you've given us a view of the first 6 months. What do you foresee happening in the next 6 months? What are things that we need to look out for? What are some of the risks and uncertainties? But also, what are things that we can be optimistic about?
Yeah, that's
That's quite a broad question, I know.
Yeah, it's a very broad question. I think, of course, as Haji will tell us, that's all in the ghaib, right? We don't know that, right? But on the basis of information that we have at the moment, right? Structurally, we remain quite positive on gold, number one, and we think that the let's call it the longer term drivers for gold continue. Inshallah, its march towards 4,000 and above remains in place. Should that be the case, obviously, given the structure of our market and the JSE as a whole, that's also going to have quite a significant impact upon the performance of the JSE. Number one. Number two, you saw from the platinum chart as well. Yes, it's gone absolutely sort of ballistic. It's certainly due for a breather. But once again, the outlook still looks good there. When you look at some of the other sectors on the JSE, what we would call our more domestically facing industries, like our retailers, some of our telecommunications companies, and so on. These are, from our perspective, are extremely attractive, and it's quite interesting. Also, just zooming out, this march away from globalization, or from a reduced globalization, not necessarily away from globalization, increasingly makes domestically focused companies a lot more attractive, right? Because domestically focused companies are not necessarily going to be massively swayed or buffeted by changes in global regulations of which they have no control over, right? So if you're selling your products overseas in dollars, tariffs can go up, so many regulations can change, and that may have worked for the last 20 years, but we're now in a new period where actually things can change quite dramatically. Maybe you actually want to be exposed a lot more to the domestic consumer as opposed to the global consumer. And there are some really, really interesting stocks that are appearing on our radar, especially as far as some of the retailers are concerned. Also, telecommunication stocks. Yeah, I mean, they've done well, but they continue to look well. Good stocks like MTN continue to look good. Blue Label Telecoms has done exceptionally well, and if I had to sort of summarize that, I would say more domestically focused stocks are a lot more interesting from our perspective, but we probably also would combine it with, of course, areas where South Africa actually dominates or is a significant player, which could be gold and or platinum as well. In terms of investing offshore, I think it's no longer a one-way bet where we had, for the last sort of 15 years, we had global markets, but in particular the US market outperforming everyone else. that relationship has now changed from our perspective, and not necessarily because those companies are bad, but simply because the opportunities for a change. And remember when I broke down the drivers of return, I said it can either come from the earnings growth of a company, or it can come from the dividend yield.
Yes.
Or the third part I said was a change in the valuation. And the fourth part I said was currency. Now we concede that, let's say, the US stock market is likely to give you really good earnings growth still, potentially. Dividend yield, they don't really pay much dividends, so it's really earnings growth. Then we look at what we spoke about, which was valuation change. There, the US market, by historical standards, it is exceptionally expensive relative to history. So the potential for further change in valuation is very, very slim. We're not saying it's impossible, but it's very, very slim. However, the final component of the return, which is the impact of the currency, it is likely to be, from our perspective, likely to be negative. And as I told you, why is that? We've just seen now, for the first 6 months of the year, as I told you, for the first time in 52 years, the dollar has actually weakened the most on record by 11%. And that's because global investors, in this period of uncertainty, to a topic of uncertainty, they have been historically, they have been massively, almost in a sense, over-invested in the US. So now they're taking some of that money home. They're taking that money, they're selling some of the US assets, and they're bringing it back home. And they're investing it back home in their local markets, whether that be in Europe, whether that be in South Africa, whether that be in Japan or China, whatever. They're investing it back home, and that then, when they do that, they have to do what? They have to sell dollars. They have to sell dollars, which then causes the dollar to weaken. Which causes the dollar to weaken, and then causes their home currency to actually strengthen.
Absolutely.
Causes it to strengthen. So we think investors should continue to have an allocation towards offshore investments, but not necessarily as high as they were before, simply because that currency effect is likely to be a significant headwind or drag on your performance.
Yeah, so if I look now at some of the sectors that you pointed out in some of your slides. So, for example, we saw of all the sectors that were on the slides, financials were at 18% or so. Now, if you were to put on your Sharia-compliant, portfolio manager hat, you say, okay, well, I would not be able to invest in financials in any case.
Yes.
Right? And resources is really where a lot of the Sharia portfolios are predominantly invested in, for the most part, depending on the portfolio and the mandate and what they can actually buy. So, what has this done for performance of Sharia compliant portfolios now over the, let's say, since the start of the year? And have you seen a lot more of the portfolio managers start giving portfolios more exposure to gold specifically?
So it's quite, that's a very interesting question. So, the investors, and whether that be conventional investors or even Sharia compliant investors, some of them, they would never invest in gold. They would never invest in gold. They almost.
What is it, Saleigh?
They almost have a.
What is it about?
They have a potentially, let's call it like a structural bias against gold, right? They have a structural bias against gold. Why? Because they say they can't value it. It doesn't produce. It doesn't necessarily produce. Let's call it cash flows, as they would say. Then and that applies in the South African context. It applies within the global context, and so on, right? And even in the Sharia compliant context. So there are going to be obviously Sharia compliant funds that have got very little gold or no gold. There are going to be Sharia compliant funds that do own gold. So I think, you know, when you're looking at Sharia compliant funds, we just need to be mindful what is the investment managers not necessarily view at a point in time on gold, but structurally towards gold. Do they have a love-hate relationship with gold? It's like, I'm never going to buy it, right?
Yes, yeah.
Or do they have an open mind? And they say, look, you know, there are times we're open to buying gold, or whatever the case is. Number one. Number two, the other thing, of course, that has also been a significant driver of the differences between the returns on the various funds would have also been how much of their assets are allocated offshore. Right? So some funds may have had a very high allocation towards offshore assets, and others may have had a significant allocation towards domestic assets. And as I showed you from the very first slide, the very first few slides, was that there was a huge difference between, let's say, just in the first 6 months of the year, where the S&P was actually down 1% in rand terms, whereas I think our domestic market was up 25%. So now you can imagine if you've got 40% of your assets invested into something that's gone minus 1% and 60% in something that's gone up 25%, that's going to be very different towards another fund that is maybe 80% invested in an asset that has gone up 25%, and only 20% in an asset that's gone down 1%. So that difference is in what we call asset allocation. I don't really like to use that word, but let's just call it in the makeup, in the mix, can have a significant bearing on the performance differentials between the various funds. And then, of course, finally as well, especially given the dramatic performances as well that we've seen between gold and platinum as well, what their allocation would have been towards gold and platinum as well. To your further question around Sharia compliant funds and investing in banks and so on, of course, banks have done, I think, if I recall correctly, I think it was like 18% or something. And yes, of course, Sharia compliant funds are not invested in that, but there are opportunities to invest in other what we call interest rate sensitive stocks like retailers and so on, which will also likely do well if financials do well.
Okay.
Right. Because of course, as interest rates comes down, what that means, for example, is that consumers typically have more money to spend, which then means that the retailers are typically going to see greater volume growth, greater growth in their profits, which then ultimately means that it's to my equation where I spoke to you, what are the drivers of return? That first driver of return, earnings growth, is likely to be better than expected if interest rates, for example, fall.
Saleigh Salaam, that's very interesting. One of the things I wanted to touch on tonight was obviously what's happening in the Middle East with Israel and Iran. What has been the biggest impact on the market since that has basically spilled over in the Middle East?
Yeah, so the what I would call the uncertainty, the uncertainty premium, the compensation that investors by and large demanded or required has actually gone up. And this is across and measured across a range of different sort of market market indicators. Some commentators are estimating up to around 30 to 40% of the increase that we've seen in market volatility has been purely because of increased uncertainty. Now, the immediate sort of impact of the war between Israel and Iran was, of course, just as the war kind of started, was, of course, we saw oil prices going up, right? But actually, many of the very sophisticated sort of investors and hedge funds, actually at that point in time, as soon as the oil price spiked, right? As soon as the oil price spiked, what they were looking to do was actually wait, like with a finger on the trigger, literally, to actually sell their oil exposure. Because they were taking a view, essentially, that this was the peak of the hostilities, and that this would be resolved quite quickly, and that ultimately the oil price would come back. Now, of course, that is one of the outcomes of an infinite number of potential outcomes. But that was the outcome that came to be realized. Right? That is one of the outcomes that actually came to be realized. Remember, the future is unknown and consists of infinite possibilities, but only one is going to be realized, right? The one that came to be realized was that there was a cessation of the war, and consequently we saw oil prices pulling back quite significantly. But it was quite plausible and possible that things could have actually not been resolved quite quickly. Could have been a protracted war. And why is that important? Because around 20% of the world's oil actually goes through the so-called Strait of Hormuz. 20%. I mean, that's a big number. So the Strait of Hormuz is actually called, from a military perspective, it's called a choke point. It's called a choke point. Like the South China Sea is a choke point. Why? Because so much of China's goods that they either import or export goes through that strait, through the South China Sea. And if you want to really shut it down, all you have to do is close that point. Much like, I don't know if you remember, apartheid era planning, right? When they planned many of our townships, what did they have? One road in and one road out, or two roads in and two roads out. If they want to seal the township, what do? They just go to those two entrances or one entrance, and they shut down the whole place. Now that's what the Strait of Hormuz is to global oil. And of course, it was possible that if they shut that down, that the impact of the oil price could have been quite significant, and that of course the gold price would have also gone above 4,000, and of course for us investors back home, we would have seen our pump price go up dramatically. We would have seen inflation, or expectations of inflation also going up, and maybe even interest rate hikes to kind of try and control inflation. So that's why that region, of course, is really important. But something that's also needs to be borne in mind was prior to the hostilities, actually, or the war, when President Trump actually visited the Middle East. What was quite interesting was, and that was maybe a month, maybe 2 months before Israel launched the attack on Iran, was at that point in time actually OPEC, surprisingly, unexpectedly, increased the amount of oil that they supplied to the market. This was Saudi Arabia, actually increased the amount of oil to the market. What does that do? That then brings down the price of oil. That then brings down the price of oil. And it is very, very interesting that actually one of the top sort of commentators that are investment commentators actually said it's quite curious that Saudi Arabia or OPEC would actually increase the production of oil, the supply of oil, which then brings the price down, and then shortly thereafter there is these hostilities. So now what happens when the price of oil goes up? It goes up from the lower base.
Okay. So it's almost as if they may have known that something's going to happen.
It goes up from the lower base. It doesn't go up from the previous base. So that extra slack was basically put into the system ahead of the time. Ahead of the time. In addition to that, something that's also not necessarily appreciated is that I don't know if you recall, I also spoke about the Silk Road, right? Is that China has actually created is basically in a sense busy recreating the Silk Road, and what they've done is they've created a train line that moves from the one side of China all the way to Iran, and they are able to ship goods and services, and even over time perhaps oil, that be able to move along that line, and they will also put in a pipeline to take oil directly to China so that they can avoid that choke point. And they can guarantee their supply.
No, that's so interesting, because I think at one point one of the criteria for Iran and Israel now coming to a ceasefire was that Iran would then still be able to sell oil to China.
Yes, of course.
That happened to be one of the criteria, one of the conditions.
In fact, that's not part of the sanctions. It's not covered by the sanctions. It's not covered at all by the US sanctions on Iran,
Okay.
because it basically means that the US would be effectively directly challenging China.
Okay.
Directly challenging China, and they don't necessarily want to do that. They don't necessarily want to do that. But I mean, we're living in a really, really interesting times. There's so many moving parts, and the changing world order, the changing politics has got a dramatic impact upon even upon the stock market. For example, one of the regions that have been relatively unscathed, to your first question around tariffs, has actually been Latin America. And why is that? Because as the US, for example, in a sense retreats from being this really globalized power stroke, almost empire, they're going to be focusing a lot more on the so-called Western Hemisphere, or North American or American Hemisphere, which means US, Canada, Greenland, South America. Where are they going to get cheap labor from? Where are they going to get cheap commodities from? The easiest and most logical place for them to get it from is from South America.
Yeah.
Right? Is from South America. And if you look at the performance of Latin American assets, the stock market, the bonds, they've done extremely well. They've done extremely well because actually they're not really subject to any of the tariffs. They're not subject to any of the tariffs, but other regions that are outside of that, let's call it American Hemisphere, are obviously going to be potentially negatively impacted by tariffs. and consequently, their performance has been a lot more patchy and a lot more variable, depending upon are they being impacted more or less by the tariffs. And one of the sort of like really interesting opportunities out there is actually a company called Canadian Pacific Railway. I think I referred that to you the last time as well, because they have a railway network that connects Canada, the US, and Mexico.
Okay.
Right. So imagine now you've got factories you're manufacturing goods in Mexico, or even somewhere in South America. You just get it to Mexico, put it on the train, and you send it through into the US on Canadian Pacific Railway. That's great. So that company is going to be a massive sort of beneficiary of that, and they are the only railway network that connects essentially the whole of North America and including Mexico.
That's a massive landmass.
In one network.
Yeah, massive landmass. Saleigh, just to end off, I didn't even get around to talking about inflation, interest rates, but in navigating all of this information with what's happening globally, the changes in the current world order, tariffs, wars, interest rates, where do investors? So your point with your breakdown of markets was that South African investors don't necessarily need to go offshore with all of their assets.
Yes.
To be able to make really good returns.
Yes.
And that's been proven. Right?
Yes.
So I think that's your point. But moving forward now, for the audience, what should the audience be looking out for? And we said we don't have a crystal ball, but specifically on the Sharia-compliant side, we know we love gold, we like gold, but what else can we or the investor look at from a more holistic perspective and say, okay, these are the types of sectors or the types of places that we need to focus on to be able to make money over the next coming 6 months or 12 months or so?
Yeah, so I think it's really important that investors, number one, make sure that they are adequately and sufficiently diversified. That's sort of the only free lunch that investors have. Make sure that you are adequately diversified. So yes, of course, you are going to have some global assets. You are going to have some local assets, etc. So that's point number one. Point number two, I would also say, coming back to sort of first principles in terms of what you can also control, is in connection with in liaison and in partnership with your financial advisors to make sure that you're not paying an arm and a leg for access to these products. You must be as cost effective as possible, because ultimately the costs eat into your return. Thirdly, and maybe this is probably a lot more, I suppose, technical, but I think just at a very high level, it's important to understand. It's important to understand where in all this noise that is out there in the markets and in the world. I always center myself in trying to think of sort of like on a first principles basis, coming back to that sort of very, very basic equation. Where do I think I'm going to make my money? Is it going to come from the currency mostly? Is it going to come from the earnings growth? Is it going to come from the dividend yield that I'm getting? Is it going to come from the change in valuation? Where is it going to come from? Right? The ideal investment is going to give you're going to make money across all of them. But it doesn't always work like that, right? It doesn't always work like that. That's in theory. In practice, it can be a lot more skewed towards one or the other, but at least to have a good sense as to where you think the drivers of your return are likely to come from, and make sure that you are adequately diversified within that. So, for example, you may have some investments that you think are going to give you the bulk of the return just from the change in the valuation. And then you may have some investments that are only going to give you really, really good income. Right? Whether that be your property portfolio or rental income or whatever, that's only going to give you income. Then there's going to be others actually that's going to give you really, really good earnings growth. And you're quite confident that that's going to be the main driver of your return. And I think ultimately I try and bring it down to those 4 or 5 things. What are the drivers of return, and can I diversify adequately across those different drivers of return? I also want to say that I think we are truly living in historic times, and the rule books of the past are not necessarily going to be what applies going forward. Okay. And that means you have to be able to think in first principles, and you've got to also have I would say some dry powder as well, some cash reserves that you can deploy, if interesting opportunities arise from time to time.
Saleigh Salaam, it's always interesting to speak to you. And I think the longer we speak, the more questions and points we would like to cover. And it's always difficult to pull the plug on the conversation. But unfortunately, we have run out of time. So I want to take this opportunity to say shukran for availing yourself on the podcast. And I'm sure we'll have you back in the future. Jazakallah, shukran so much.
Yeah. Saleigh Salaam, CIO of Vunani Fund Managers. Always a pleasure. Shukran for sharing the wealth of knowledge. I had so many questions. I still have some more, and I hope that you'd honor us in being back on the show soon.
Inshallah. Thank you so much. It's always great to spend time in your company, and I certainly benefit a lot as well.
Okay. And there you have it, guys. If you like this episode, please give us a thumbs up, leave a comment, hit the bell icon, and assalamu alaikum wa rahmatullahi wa barakatuh.